In this episode, I'm going to dispel the second biggest myth about max-funded indexed universal life. And if you want to know what it is that level is the devil. Ha! Whenever I hear that, I just roll my eyes. They simply don't know what they don't know. If you're using a max-funded IUL for what it was originally designed for, living benefits, you don't want to use the increasing death benefit except for younger people until they stop funding it, and then you switch it to level. You want the insurance to get cheaper as you get older. Otherwise, it's going to keep getting more and more expensive, and that's why the naysayers say, oh, it's going to crash and burn and it's going to implode. That's only if you do the stupid thing and use the increasing death benefit. The level death benefit is what you want sooner or later. What is this myth that I hear all the time? Well, the level is the devil. Every time I hear somebody say that or quip that, I go, oh, bless your heart. You got a little rhyme there, don't you? You don't know what you don't know. Now, to understand the difference between a level death benefit and an increasing death benefit, I'm going to use an example here and keep it simple. But when universal life was first introduced, the brainchild of B.F. Hutton back in 1980, and then indexed universal life came out in 1997, the purpose was to use cash value life insurance, universal life, primarily for living benefits, more than the death benefit, okay? And so what you're doing is you're accumulating your money tax-free under Section 72E of the Internal Revenue Code. And then under 7702 of the code, you can access your money the smart way without triggering income tax, even before the age of 59 and a half without a 10% penalty. And then at the end of the day, when you finally do pass away, anything left in there, it will transfer income tax-free, and it will usually increase or blossom in value, okay? Nothing else does that, by the way, in the Internal Revenue Code. I've asked CPAs and tax attorneys for years that I teach advanced continuing education to show me any other investment that does that, and they've yet to show me anything. So that's the beauty behind it, and that was the brainchild of B.F. Hutton. But see, instead of trying to get X amount of life insurance for death to pay off if you die for the least premium you can get away with, you're doing the opposite. You're going to use it for living tax-free accumulation and tax-free access. And so you want the least amount of insurance you can get away with and put in the most money, premium, the IRS allows, and this thing turns into a tax-free cash cow, okay? And so when you understand this, you don't want to use the increasing death benefit if you want the insurance to get cheaper as you get older. Because if you choose the increasing death benefit, it's going to keep getting more and more expensive. And then the naysayers, and that's the number one myth, oh, the policy is going to crash and burn because the cost of insurance is going to go through the roof. Well, that's because you didn't max fund it and you chose the increasing death benefit, okay? You don't want to do that. But they think that they're so cute with this little quip, oh, level is the devil. So let's explain the difference between the two, first of all. And I'm going to use a metaphor that I've used in my books and videos for years. It's a bucket. So when we have indexed universal life, we want a repository, the policy, like this bucket to accommodate the amount of money that we want to be allowed to put in there or be grandfathered to be able to put in there so it will always grow tax-free and I can access the money tax-free. So I have to adhere to certain citations, tax citations in the Internal Revenue Code, okay? So I'm going to use an example of a 60-year-old male. It doesn't matter what age you are. If you're younger, if you're in your 20s and 30s, and you're going to be socking away $500 a month, let's say, into an IUL policy to accumulate your money tax-free, better than putting that same $500 into an IRA or 401k, you'll realize it is way better because this is tax-free. You might start with the increasing death benefit to be able to sock away $500 a month for 20 or 30 years. But when you have finished putting money into that IUL policy, you want, by that point at the latest, to switch to the level death benefit, or else the cost of insurance will keep getting higher as you get older. Now, sometimes these proponents that say level is the devil, they're saying, well, hey, if this 60-year-old male puts $500,000 into a policy, it used to be way back in the 1980s that they could do that in one fell swoop. That was called single premium insurance. And we had many clients actually do that. put in $500,000. And then immediately, back in the 1980s, Universal Life, I never got credited less than 11.75%. From 1980 to the mid-1990s, I got credited as high as 15.5%, okay? But if I earned 11, I could be netting 10% on my 500 grand. And so we had people throw in 500,000, immediately start pulling out 50,000 a year of tax-free income. It was incredible, okay? And they took the least amount of insurance to keep the cost low. They did it for the income. They wanted tax-free income. That's the purpose, a living benefit, not a death benefit. That's secondary. If they happen to die, well, it pays out more than the money they had in there. But the objective is tax-free income. So you take the least amount of insurance so that the spigot on the bucket is draining out costs, the cost of the insurance that the IRS says has to be there or it will not be tax-free, okay? Now, that spigot is actually watering a nice little money tree down here that's going to actually blossom when you do die. So it's really not a cost, it's a benefit. And when you think about it, it's the cost of the insurance is being paid for indirectly with money that most Americans shell out in unnecessary income tax. See, you'd have to be earning 15% in a tax-deferred IRA or 401k in mutual funds. You'd have to earn 15% to net 10 after tax in a 33% bracket. Here, people back in the 1980s only had to earn 11 to net 10. That 1% was the cost of the insurance, but they could more safely earn 11 and net 10 than putting their money out in the market, and they have to earn 15 to net 10 after tax. So that's why money was just going from the brokerage firms and the banks and credit unions into these. These were safer. They paid higher interest. They were tax-free, and they would blossom if you died. Banks and credit union brokerage firms, they couldn't compete. And so that's why, long story short, the IRS had to create some parameters so that people wouldn't be taking advantage of the Internal Revenue Code, where your money accumulates tax-free inside of a life insurance policy. They said, oh, we think you're overstepping the bounds. And if you violate these sections of the code, we're going to move it over to investments. The investment section of the code, investments are taxable sooner or later, and they're usually subject to volatility. If that's the definition of an investment, I don't want one of those. I'd rather have tax-free insurance. And so people were putting money in these, like I said, in one fell swoop. And TEFRA and DEFRA, these are tax citations passed in 1982 and 1984. And they basically dictate the minimum amount of insurance that has to be attached to the account so that it doesn't exceed the definition of tax-free insurance, okay? So TEFRA and DEFRA gave parity. Parity means equality. If people were using this for living benefits, the older you got, the less insurance you could get away with. See, if I had a 20-year-old female that wanted to reposition $500,000 to increase the liquidity, the safety, the rate of return on tax benefits, she might be required to have $4 or $5 million of life insurance, but the spigot on her policy at age 20 is the same size as a 60-year-old who wants to put in $500,000, and he can get away with only $1 million of insurance. Yeah, so that the cost of insurance for the 60-year-old is draining out no more percent. If he earns 11, he nets 10. No more money than the 20-year-old, because the amount of insurance required goes down as you get older, okay? For example, I had a 78-year-old friend of our family who came to us with 3 blocked arteries, adult onset diabetes, a prostate cancer episode. He had 6 sisters, all predeceased him, and 3 brothers. So he was 78 years old, and he was rated table D. That means insurance company says you've got the life expectancy of an 83-year-old. The cost of insurance for you is double than most 78-year-olds. Well, once I knew that, he wanted to put in $500,000. Why? To have the best rate of return. He wanted to earn 11 and net 10 and pull out 50 grand a year tax-free. Knowing that, the minimum death benefit for him was like $800,000 if he was healthy at age 78, because he was rated table D and the spigot was twice as much. we lowered down the insurance down to like $650,000, and now he could earn 11 and net 10. The cost of insurance for him was the same as a 20-year-old female. Now, a lot of agents don't even understand what I just said, but if you structure this correctly, the cost of insurance is the same, no matter how old you are or how unhealthy you are. If you're totally uninsurable, you can actually own one on your spouse or your adult children, maybe. See, it's the owner of these IULs that gets all the tax-free income. Now, let's use this example to show you what I'm talking about. If a male age 60 wants to put in $500,000 to optimize that money, to increase liquidity, safety, ready return, and tax benefits, then if he used the increasing death benefit, okay, which is what they say, well, if you die, don't you want your money added on top of the death benefit? Yeah, well, oh, yeah. Well, if you want to maximize what you leave behind, but guess what? Every time if your money keeps growing in there, they have to pay out that on top of the original death benefit. The cost of insurance is getting more expensive as you get older. The purpose here is to make the insurance get cheaper as you get older. That's what you get with a level death benefit instead of the increasing death benefit. So let me make sure you understand this. If this male age 60 wants to put in $500,000, in 1988, the banks and the brokerage firms and the credit unions lobbied Congress because they couldn't compete with these. These were safer, paid higher interest. They blossom when you die. They're tax-free. And so they didn't want to kill these because this is where banks and credit unions put 30 to 40% of their Tier 1 assets for liquidity and safety. So they didn't want to kill these because they use them. But they wanted to slow the flow of money. They didn't want to see $500,000 leave their bank or credit union in one fell swoop to go over here. They said, well, just make it so they have to spread it out a little while so we see the money leave slowly. So under TAMRA, a male age 60 who wants to put in $500,000, if they did that in one fell swoop, the money still grows tax deferred, but it's called a MEC, a modified endowment contract. If they die, it blossoms and transfers tax-free. But if they access money, it's now taxable. If they want tax-free access, they comply with TAMRA, the Technical and Miscellaneous Revenue Act of 1988, which means they can only put in about 25%, maybe 125,000 the first year, even the first day of the first year. And then in 1 year and 1 day, even just 1 day into the second year, they can fill up another 125,000. Maybe they have half of their money in there by now. Okay. Now, see, if they die, the insurance company still pays out just the level death benefit of $1 million. What happened to the money? Well, your money was part of the death benefit. The insurance company is only charging you the difference between the cash you have in there and the death benefit. The insurance is getting cheaper as you get older. In this example I just gave you, this 60-year-old male, 2 years later, is only being charged for 75% of the insurance risk that he was 2 years earlier. Let me go a little bit further. He puts in another 125,000, another 125. In basically 3 years and 1 day, he could have his 500,000 in there, and now he's complied with TAMRA, and all the money in here will grow tax-free forever after. Now, wait a minute here. The spigot on the bucket, when this bucket is full, when he has 500,000 in there, and this is growing interest actually, but see, if he dies, they pay out $1 million, but $500,000 of that million was his own money. That's a good thing if you want to keep the cost of insurance cheap because he's planning on living. And so the net amount of risk is the difference between this and the money you now have in there because you're self-insured. You now own half of the death benefit. You're converting your money to tax-free because you're going to own the death benefit. That's how you convert your money to tax-free the rest of your life. Now, many of my clients earn average returns of 9.6. If you divide that into the rule of 72, your money will double in 7.5 years. So in this example, 500,000 would double to $1 million. And all of a sudden, in 10.5, 11 years, this male age 60, the cash has grown to equal the death benefit. If he dies, they leave behind $1 million, right? In actuality, if he died when he has $1 million of cash value, they pay out $1,050,000, 5% more. And that keeps the definition of tax-free in the code. but they're only charging him for $50,000 of net amount at risk. The interest he's earning on $1 million in there now dwarfs the cost of $50,000 of insurance. The spigot on the bucket is down to 1/20th of what it was 11 years earlier. That $1 million of cash could generate $100,000 a year of tax-free income. Okay, it couldn't do that if he had the increasing death benefit. If he earned 11, he'd only be netting 7 or 8. I want to earn 11 and net 10. I want the cost of insurance to get cheaper as I get older. That is done with the level death benefit. Okay, if a younger person is funding it, with monthly payments, $500 or $1,000 a month, at the point in time when they stop funding it, they should switch to the level death benefit to make the cost get cheaper as you get older. If you don't need any income yet, that $1 million of cash value in the 11th year would double by the 18th year, probably to $2 million. Now I have $2 million of cash. If I die, it leaves behind $2.1 million. The insurance company's only charging me for $100,000 net amount at risk. The interest I'm earning on $2 million dwarfs the cost of $100,000 net amount at risk. This is why you want to use the level death benefit, so that the cost of insurance gets cheaper as you get older. In the 20th year, if he earned 11, he'd be netting 10.9 net cash on cash return. But retroactive back to day one while he was filling it up, if he averaged 11, he'd probably be netting 10. I want that spigot to drain out only about 1%. You do that with the level death benefit. If you chose the increasing death benefit, if you earned 11, you might only net 8 or 7. Are you getting it? So that is the myth about, level's the devil. Not if you're using this for living benefits. Level will keep the insurance cheap, and it will get cheaper as you get older. Increasing death benefit, the cost of insurance is going to get more expensive as you get older. So hopefully you've gained some insights here. If you want to see some actual examples, claim a copy of my most recent best-selling book, The Laser Fund. It's been flying off of our warehouse shelves. And this is actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're more of a right brain learner, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your right brain and your left brain, your whole brain, I would read both of these books. But it's 300 pages. It retails on Amazon for $20 up to $60. And if you buy it on Amazon, I want to thank you. But I'll gift you a copy for free. Simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game. I'll pay for the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can also register for a free educational webinar that we teach on a weekly basis. But you can even schedule an appointment to talk to an IUL professional to see how a properly structured max-funded IUL will work in your particular set of circumstances, no matter what your age is, so that if you even start out with an increasing death benefit, if you're in your 30s, you switch to a level death benefit, and they'll show you when you should be switching so that the cost of insurance gets cheaper as you get older. So hopefully you've gained insights, and I've dispelled this number 2 myth about IUL. Please watch my other episodes to dispel the other major myths about IUL, because if you don't, you're going to be missing out.